I'm John O'Lippin. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on the markets right now. We are down 1 solid percent on the S&P 500 at 44.53 right now. The level off almost 44 points. The 10-year yield continues to rise. So another 2 basis points today as investors sell that debt. Right now, the level at 428.16. The Bloomberg Dollar Index also continuing to gain ground. So a continuation of the trends that we saw yesterday at this time. The Bloomberg Dollar Index trading up at 1255, 1256, and NYMEX crude rising, Brent up as well. Right now, WTI, John, at $87.61 a barrel.
Well, it's interesting to see that move in crude, and yet in the equity market, Matt, you've seen a bit of cautiousness with stocks, even energy stocks, because of that new economic data in the United States, suggesting maybe the Fed stays higher for longer. But the central bank story getting attention here in Canada as well, because we saw Canada's central bank hold rates steady at 5%. Now, they were already at the highest level in 22 years. This decision was expected, but it is only the 3rd time in 13 meetings that the bank has hit the pause button. And part of that is because we saw the economy contract in the 2nd quarter. The Bank of Canada itself was not expecting that, and it spoke about excess demand in the economy starting to ease. And yet, in some of their messaging, there is still a hawkish tilt, given that the inflation fight is not over. I want to bring in Claire Fan from the RBC economics team to get some reaction to the messaging here from the Bank of Canada today. Claire, great to have you with us. What did you make of the fact that, on the one hand, they stay steady on rates, but they do send to the market a hawkish message? Did that surprise you?
I mean, not really. Well, first of all, let's start with the decision itself.
Sure.
With the Bank of Canada obviously deciding to hold rates steady at 5%. I think what we want to call it at this point is a hopeful pause. So the Bank of Canada here is really hoping that they've done enough, with 475 basis point cumulative worth of rate hike that we've seen to date. So I think the question that they're asking now is really, we're starting to see weakening data, especially in labor markets, and the GDP data last Friday as well. I'm sure we're all aware. So are those foreshadowing a broader slowdown that we've all been anticipating as sort of a fall off for the rate hikes that we've seen today? Or is this a repeat of 6 months ago, when GDP just bounces right back up? So I think ultimately that's the question, and that's what prompted the pause today. But like you said, the statement was sounding a lot more hawkish, so that's down to them ultimately wanting to leave the options on the table. They want to leave the door open. So if they were to move rates higher again in October, given maybe more persistent than expected inflation reports or data, they could.
Yeah, and they've got to navigate the fact that we're next to the United States, which there's the possibility that the Fed continues on that rate hiking path. We'll see how that plays out. Claire, maybe identify for our global audience the differences in household debt between the U.S. and Canada. We have a shorter duration mortgage market in this country, so you have a lot of people who have already felt that impact of all these higher interest rates.
Yeah, that's definitely right. So the typical mortgage term is obviously a lot shorter, so which is similar to situation in the U.K. Very different from the U.S., where mortgages are typically way longer, 30 years. So that does allow, like you said, a lot faster pass through. Although it's still been kind of slow. GDP contracted in Q2, which is, a full year after the start of the Bank of Canada's first rate hike back in 2022. So if you look at the delinquency data as well, we're starting to see higher delinquency in market-wide auto and credit card loans. So we are starting to see signs of households, getting squeezed with heavier debt burden, with rates staying at currently high levels. So that's just one of the key differences. And in terms of the outlook for the 3rd quarter, StatCan's prelim estimate for July did point to a flattish profile for the month. So to be honest, that leaves the start of the quarter to a weaker or a softer start. So whether it can really bounce back to match the Bank of Canada's forecast of 1.5 annualized percent increase in GDP is a huge question mark. And if it can't, that leaves us tracking a lot below what the Bank of Canada last forecasted.
Claire, how long is the transmission from monetary policy changes to the effect on the economy? It's been a debate lately. Here in the U.S., Jan Hatzius says he doesn't think that long and variable lags are very long anymore. On the other hand, so many people have fixed 30-year mortgages here and have moved away from the arms of, the great financial crisis and previous, that people have argued those lags are going to be even longer. What's it like in Canada, and what's your view on the U.S.?
Yeah, so that's a great question, and it does, play a lot into the differences between just how indebted households are. I mean, post the great financial crisis, the U.S. actually had a larger deleveraging cycle. It means that debt to income in the U.S. generally is lower than what we're facing here in Canada. So it comes to not only, the speed of how fast monetary policy can really start to flow through to impact household decisions and slow aggregate demand. It also comes down to the sensitivity, because with a larger debt, you are by definition more sensitive to the same 25 basis point worth of rate hike, let's say. So that's obviously one of the key differences as well. And in terms of the lag, this point, I think is really, surprised a lot of us in terms of just how resilient, broadly speaking, households have been. And that's true for both Canada as well as the United States. Obviously, we both know that there's an incredibly large amount of excess savings that the households have accumulated over the course of the pandemic, and that's helped insulating them in a lot of cases, through a lot of the interest rate and high inflation shocks to their finances. But in Canada, things are starting to look a bit softer. We have the unemployment rate, again, rising by as much as 0.5 percentage point within the span of 3 months. So previously, we have not had that without a recession. So that is just sort of giving the context of how economic conditions are starting to look like in Canada, and where it could trend ultimately, again, back to the Bank of Canada. Is it weak enough or deteriorated enough for inflation to slow back to target? I think ultimately that's the answer that we're all waiting for more data releases to find an answer to.
And then to go beyond Matt's question about the lag on interest rate impacts, I think worldwide markets have been wondering, once you start to see those impacts from higher rates, is there an entry point for central banks to at least lower rates even slightly? And that conversation is starting to gain momentum in Canada simply because, we talked about that contraction for the economy in the second quarter. You mentioned, who knows, if you see a bounce back in the economy, if the inflation story is not fully resolved. Would you be surprised, though, if the Bank of Canada going into next year were to decide, look, things are weakening enough, we actually have to send a message that we're going to lower interest rates here?
That is a great question. And I think at this point is not part of their concern. It's definitely a bit premature for them to think about cuts at this point, because, again, the key question that they're trying to answer now is, have we done enough? That's the only question. And once they deem that broader macro condition will slow enough for inflation to persistently drop, not headline inflation, core inflation more so, excluding some of the energy, oil price shocks that the Bank of Canada also mentioned in the statement today that could be pushing inflation higher in the near term still. So will core inflation really come down to 2%? And once they have an answer to that question, maybe together, what really drives that slowdown in inflation, what underpins that forecast is the slowing in demand. And that's what we're starting to see. And that's also in large part what made them pause today, is that, maybe the slowdown in demand will be enough to push inflation down. Once they get a yes to that question, then we can have more of a discussion as to, where do rates move on from there.